Welcome to the What to Watch video update. Every week I do a whole lot of different videos. I do a video every day, I do a weekly video, I do an intermarket analysis video. Then I go through all the charts and those that I didn't really use all that much, I put into the deep dive video. And then the last video I do over the weekend is where I pick out what I'm really honing in on for right now. Now, this can change, but if you've watched any of these previous videos, there are some charts that you'll see all the time because they need to be watched all the time. There's others that go from positive to negative and negative to positive. There's also a watch list of things that I'm just keeping an eye on, and I put them together into this video. Before I get going on that, though, I want to tell you about the SPX investing program. It's up, it's going, it's free until the end of 2024. Then I'm going to be locking it down. There are additional videos that I post there. There's a link that'll take you to the website or to a video that talks more about the program. If you want to contact me, have any questions or anything like that, here's an email address that you can do that. Also, as I mentioned, the daily video, that's really what I focus on in my analysis. Well, then the last video I do is the what to watch video. And then around the outside are all these videos that I do once a week. The supplemental videos, I just post those on the website, and that's just kind of on an as needed basis. Okay, so the first thing that I go through is look at those things that are positive. Now, even though they're listed here as being positive, there usually are some negative things that we can look at. Just like when I get to the negative section, there are some positive things that we can look at. And these go back and forth as the market goes up and down. The first one is we're positive here, and this is the ADX. And I use this to measure the condition of the trend. When we're in a solid trending environment, whether it's up or down, the ADX will go up and it'll be above its moving average. Well, as we've been chopping along sideways, we're actually starting to drop, and we're in danger of dropping below the moving average here, which suggests a weakening trend. So that shows us that the trend is not really strong, and you can see that reflected in the price movement. We haven't been going up or down all that much, even though we had a down week. Now, we can also look at this and say, is it positive or negative? When the green line is above the red line, that's positive. But you see the green line's coming down as the red line's coming up. So we're not really seeing any strength here right now, but we are positive. Now, this version of the ADX, this measures the short term. The one that I really focus on is the intermediate term. This is another, it sets the times different here in the indicator. We're also in danger of coming down to the moving average, but we're still positive, but the green line is coming down for the condition of the positive trend. Now, this is positive, though, and we've been seeing this even over the last week. We went down Monday, Tuesday, Thursday, and we were unchanged on Friday. We did have an up day on Wednesday, and the blue line continues to go up here, and that is positive. This is an intraday chart of growth versus value, and this is encouraging that some of the smart money is coming in and buying growth, and that could be in anticipation of prices moving higher. So we like when the the blue line is going up. Now, another thing that's a little more positive here is we see the red line going down. That's value. That's when the market is being more defensive. And that has been declining as the blue line has been going up. So on an intraday basis, this is looking pretty good. Also, we look at an intraday chart of growth versus value for the S&P. Right about at the end of November, we started to see growth outperforming value, and that's more encouraging here. Then we're also keeping an eye on risk on versus risk off. When this is going up, that means the market's willing to take on more risk, and that usually is when the mega caps and stocks and so forth tend to go up. And we've been seeing that going up lately, especially over the last week. The broader market really didn't have that good of a week. But the NASDAQ and NASDAQ 100, they're setting all-time highs. The S&P didn't have a great week. It ended up being down. It has those mega cap and large cap components, but it also has some value and it's more balanced in the index. But when this is going up, that just means that we're getting into more of a risk-on type of climate. Now, one thing that's encouraging is if you look under the surface at the small caps, because there's all this, small caps have the Santa Claus rally, the January effect, all that stuff. Well, it hasn't really kicked into gear, at least yet, because if you look at the index, we shot up and then we've just been trailing down here ever since. But if you look at the growth versus value ratio, this continues to go up and it's holding up quite well. And we've seen a recent golden cross here with growth outperforming value. And that could turn into positive price action. We're just not seeing it yet in the index itself. And we have to wait until things do look better with the index before we really say, okay, this looks like some kind of a setup. And we're seeing a very similar thing here with mid-cap growth to value, seeing a recent golden cross with this ratio, but the index has really been trailing off. S&P growth to value also looking pretty strong here. We ended up having a down week with the S&P. This is still holding up quite well. And now this suggests that we could see some strength in the near future, but we just don't really know when that's going to develop. We also compare a growth versus value ETF. This is looking really solid right now and way up out of the rainbow, coming up and matching the difference here that we saw last summer. And that's when the market was really solid and really going up. We're also looking good here with discretionary to staples. This has been the strongest area of the market since we had that big downturn on August 5th. This ratio has been doing really well as we've been going up with discretionary. It's got hit a little bit this past week, but staples have pretty much been going sideways. And when that happens, we still continue to go up with this overall ratio. Large cap growth just coming off of setting recent all-time highs here. So it's the large caps that are still showing the strength. What we're trying to figure out is, are we going to see that go through into the mid caps and into the small caps? We look at our growth to value ratios. These are looking pretty solid with the Qs to S&P, discretionary to S&P, large cap growth is outperforming large cap value. This is positive and under the surface. When we look at the large caps, mid caps, and small caps, also looking positive. So when you take this scenario, we can easily conclude that there could be some strength coming into the market. Now, doesn't automatically mean that's going to happen, but we're seeing the evidence coming together for that. The VIX, after being really high right around the election, it's been coming down. And for the most part, we're getting a very low reading with the VIX, both with the line chart, that's the closing value, and the bar chart. And when the VIX is low, I know VIX is low, it's time to go. But when the VIX is low, that's also when the market does its best. But the momentum for the VIX is now switched to up as measured by the MACD here. So I could have put this on the negative side here, but since the VIX has been coming down, we're under 14 right now. It would really help things if the VIX was able to continue to decline and actually turn the momentum to negative. That would be more positive for stocks and for the S&P. And this kind of bears that out. This is research done over a year ago by Tom Bowley, who's connected to stockcharts.com and also earningsbeats.com. And he posted this with these annualized returns here. And then this is a weekly chart of the VIX. And we closed at 13.81. We're not quite down below this 13 level. That would turn things even more positive. And when we have a low VIX, this is when we see the best annualized returns for the S&P. Where we're at right now is still really solid, but quite a bit less than when we get the VIX down lower. And then if we go above 20 with the VIX, that's when we start to see negative annualized returns here. So the VIX coming down is actually more positive for stocks. Then we look at the 20-period moving average. It's still looking good here, both with the simple and exponential versions here. We haven't even really come down and tested that. Are we going to do that this week? Are we going to see prices come down and actually see if these lines hold? Are we going to be able to bounce up off of them if that's what happens, or are we going to fall through them? Also, the condition of the short-term trend. This is a rainbow that I pretty much only show in the deep dive video. It goes from 10 periods up to 50. And even though we're coming down into the top end of the rainbow, we're still looking pretty solid with most of the lines going up for the time being. So this also suggests that the short-term trend is still positive. We just now need to see it follow through in the way of price. All the moving averages that we plot here are going up, prices above all of the lines. So this is still looking positive on a trending basis. Longer term, going back to the 1987 crash, we're still looking really solid here with the S&P weekly chart. The broader market, even though it didn't have a great week this past week, when you compare it to 1 to 3 year bonds, which are shorter term, stocks are still outperforming. We're still up out of the rainbow. Then this is kind of a way of measuring, are we anticipating a soft landing, meaning there will not be a recession, or a hard landing, meaning there will be a recession? And we look at this ratio and we're still up out of the rainbow here. So the market is still anticipating that there will not be a recession. This is long term, a trend channel going back to 2009. We're hitting the upper end of this trend channel. Now, we could break above it like we did in 2021, but this might be providing some kind of overhead resistance right now. It's still positive since we're hitting the upper end of that. It would be even more positive if we could end up breaking above this. Then the NASDAQ looking pretty good right now, trailed off as the week ended, but we're above this R1 pivot point, setting new recent all-time highs. All the moving averages are going up. Same thing with the NASDAQ 100. Above this R1 pivot point, setting a recent all-time high, all the moving averages are going up here. Here's a weekly chart of the QQQs, which is the NASDAQ 100, setting an all-time high here. The momentum for the NASDAQ 100 is positive as measured by the PPO. The Wilshire coming off a little bit, but setting a recent all-time high here. And this is a broad market measure that we use. Another broad market measure is the total US stock ETF. Not at its high right now, but not far from it either. The financial sector, and I've been a little bit concerned about this. Now, we're still in an uptrend overall. We haven't even come down to the 50-day moving average, but we have been pulling back. So we'll be keeping an eye on that. If we see more weakness in this sector, we'll be watching this 50-day moving average to see if that's able to hold up. The FANG index set an all-time high on Friday. And these are the really big stocks: Facebook, Apple, Amazon, Netflix, Google, Nvidia. And they're the ones that are really keeping the market together currently. And we're also coming up out of this short-term trend line here. We were wondering if this would provide overhead resistance, and it did there for a while. At least after Friday, we were able to break above this. Now we ask the question, can we stay above this short-term trend line? We look at a ratio of the Qs, the NASDAQ 100 to IWM, the small caps. Still looking good here, coming back to this blue line here and actually going back above it. Another ratio between the NASDAQ 100 and the Dow, going up here with this ratio. That's still looking quite positive. And the tech sector to the 3 to 7 year bonds, not really breaking out right now, but still up on the upper side and breaking out a little bit above the rainbow. Weekly chart of the NASDAQ 100, still looking really solid with the trend line going back to 2009. And then we look at a ratio of the Qs to the 3 to 7 year bond ETF, setting an all-time high here. All right, now we look at the negative things that are causing us some concern. And the only reason I have this on the negative side is we're right at 50 and we're ticking down a little bit. Generally, on an up day, this will go up and we're positive. If we have a down day, this will go down and we're negative. We're right on the fence between positive and negative currently. So this is in the middle right now. We're a little bit concerned about the condition of the short-term trend as measured by 20 periods here. This is a double and triple exponential moving average study. We're below both lines. Now, we haven't started to really roll over that much yet with the green line and the blue line. If we continue to fall, these lines will turn down and that will be more negative. It'll be more positive if we can get back above the blue line and the green line and see these lines actually go back up. We're also concerned about this. These are the stocks inside of the S&P 500 that are above their 20-period moving averages. We went negative this past week. We dropped below 50 and we're continuing to decline. And that's just showing some lack of short-term positive action for the S&P based on 20 periods. We also want to keep an eye on the condition of the intermediate term trend as measured by 50 periods. We're a little bit below this blue line here. We haven't started to roll over with these lines yet. If we stay down below this, the lines will roll over. If we can get back above it, the lines will keep going up. This is another area, a little bit of a concern. This is the advanced decline line. Based on price, we've been declining, and based on volume, we're declining. In the bigger picture, though, we're still positive since we're above these advancing moving averages. Then another thing is we're seeing a real contraction of the new highs and a bit of an expansion of the new lows inside the S&P. So our 5-day and our 10-day moving averages are going down. This is another internal measure. We would like to see this going back up, and it's actually going down currently. Accumulation distribution, a smart money indicator. This is calculated based on price and volume. We're dropping below the moving average, so that's turning more negative currently. We're also below zero and declining with the advanced decline ratio. 19 periods is short term, 39 periods is intermediate term. The blue line and the red line are declining now. This is a further breakout here with the 19-day advanced decline ratio below zero based on price and volume. We want to see that turn back positive to be more positive. And the Chaikin money flow, another smart money indicator, ticked up a little bit with the histogram on Friday, but the red line is still going down. And so the context of this is negative. Chaikin oscillator below zero and declining. So our three smart money indicators are negative. The vortex, okay, it's positive since the green line's above the red line, but see how the green line's coming down and the red line's going up? We need to see more strength with this indicator. And longer term, not necessarily negative, but since they're declining, I put them on the negative side. The 150 and the 200 period moving averages have been declining recently. The advanced decline for the S&P 500 based on price on a cumulative basis, we're coming down. We're also coming down based on volume. We want to see those turn and go back up. And then when we compare the S&P 500, which has pretty much been going sideways with the NYSE advanced decline line, we're seeing that the broader market is actually going down a little bit more than what we're seeing the index going down here. I know it's not an apples to apples comparison, but we can compare the S&P 500 to the broader market, and that gives us a general sense of what's happening as the S&P has been holding up better than the rest of the market. Then we look at the cumulative advanced decline line for the NYSE, dropping down here below the moving average, but the moving average is still going up for right now. We're also dropping below the moving average with this regular advanced decline line for the NYSE. And when we break it out based on common stock on the NYSE for price, we're declining, and volume, we're also declining. We want those to turn and go back up. We're seeing some weakness here with the advanced decline line studies below the moving average with the NYSE common stock, the S&P mid caps and small caps. We need these to get back above their moving averages and start to go back up to turn more positive. And we're a little bit concerned this past week. The only real increase that we saw with volume, other than Friday, because that was an unchanged day, were the down days. And to see a pickup in volume on down days is a little bit of a concern, but we've been coming back up to around average when we look at this volume oscillator. And this could be negative on one side and positive on the other. The S&P McClellan oscillator below zero and declining, but when we get down below this 60 level, that is meaning that we're getting extreme negative with this reading. And now we could still go further than where we're at right now, but sometimes we see a real nice bounce up out of this. But we need to see that confirmed by price and then ultimately confirmed by this indicator going back up. So when we're going down with the McClellan oscillator, we're going down based on price and volume with the summation indexes. And we're also declining, but not extreme, with the NYSE McClellan oscillator. So that's showing some broad market weakness. So we're going down with the summation index based on price and volume here. Swenlin trading oscillator, slowing down a little bit as it's declining, but it's still going down. And this is based on the S&P. We want to see both of these lines turn back up, and they're still continuing to go down. We're seeing a little bit of a hit taken with momentum. The PMO, the price momentum oscillator, is starting to drop below its moving average. Now, we did get a bit of a warning there. We dropped below the moving average based on price and volume before we saw the PMO actually cross below its moving average. And then there are a number of studies that are attached to the PMO. We're starting to get extreme with the PMOs that are rising. And sometimes we can get a nice little bounce out of this. But we're still declining with the buy signals, and we're also declining with the PMOs that are above zero. And these are all the PMOs inside of the S&P and what they're doing right now. And we're taking a little bit of a hit here with momentum as well, where the slope oscillator, it's been kind of really crazy lately. It was going down as the S&P was going up, and it's going up as the S&P was going down to sideways. The next short-term oscillator is the TSI, and that's been a little more realistic with what's actually been happening with price, where it's looking a little more negative. Those are the two short-term oscillators. Then there are three intermediate-term oscillators. The MACD, the PMO, and PPO, they're starting to cross below their moving averages. We're seeing the tricks and KST rolling over a little bit, but they're longer term and they take longer to move. We're also turning back negative after being positive with the Copic curve, which is another momentum oscillator. Parabolic SAR turned negative here with the dots on top. This is a primary indicator and kind of a concern to us. Bullish percent index, even though technically we're still positive since we're above 50, the context is that we're declining here. And this is not an oscillator. These are not moving averages. These are point and figure buy or sell signals inside the S&P. And P. And when this is going down, that means there's an increase in the sell signals. And that's not positive. We're also going down with the NYSE bullish percent index. But when we look at the NASDAQ 100 bullish percent index, it's coming down, but it's right at the 70 level, which is still holding up fairly well. Then we also look at the equal weight, and I went through this before here, where we've been going sideways with the S&P, and we're seeing a little bit more of a decline here with the equal weight version of the S&P as it's not been holding up as well. And we're seeing when you look at this and then the NYSE advanced decline line on the S&P, we're seeing something quite similar right now. Then we look at a ratio between the two. When this goes up, that means the weighted version of the S&P is outperforming the equal weight version, where we were chopping sideways a little bit here, meaning that the rest of the stocks were participating. Now, it's okay if we really see this go up. That's when we really have been moving with the indexes. But we would also like to see the rest of the index performing well at the same time. The Dow coming down to this pivot point and closing just a little bit below it after setting an all-time high just a week ago. But in the bigger picture, we're still positive. We haven't even come down to the 50-day moving average, and the 50-period moving average is still above the 200-period moving average. Small caps, this is where we shoot up and then just kind of drizzle back here. I was pointing out in previous videos that so far we've been able to stay above this pivot point, and that was acting as support. Nope, didn't happen on Friday. We're not drastically below it, but it would be more positive if we could get back above this pivot point. And here's the Russell 2000 small cap index where we shot up and seem to be coming back. It's like fireworks, go up and then sprinkle across the sky. We're also below 50 with the RSI. We're also negative here with the momentum with the small caps. So we need to see some improvement there for this magic thing with the small caps that is just supposed to happen automatically that isn't happening yet. Then we look at a ratio between the small caps and S&P, still underperforming here. When this ratio is going down, that means the small caps are underperforming. We've seen little blips of hope along the way here, only to have it dashed quickly. We're wondering what's going to happen this time. And here are the mid caps also shooting up, looking really solid for a few days, and then just drifting off here below this pivot point again. That's the negative side. But on the positive side, we're still above the 50-day moving average. And the 50 is still above the 200-day moving average. And we're concerned about interest rates. When they're going up, that's more negative for stocks. When they're going down, that's more positive. And we saw interest rates going back up now. And if they continue to go up, that's going to put more pressure on stocks. And we're also looking at cash versus 3 to 7 year bills. We're a little bit concerned here as this ratio is going back up. That just could potentially mean that the market's anticipating inflation. That's what we saw back in 2021 into 2022 as this was going up, and that ended up being negative for the market. CPI was considered okay. It's PPI that had some inflationary components in it that came out on Friday, and that's kind of what's causing this ratio to go back up. And we're wondering, is that just a short-term thing that the market will deal with, and it's not going to be confirmed by other economic reports, or is this the start of a new scenario that's going to be coming into the market? Home construction versus 3 to 7 year bonds, getting really close to this 250-day moving average here. Now, this has happened before. The end of 2023 came down here, bounced right up off of that. 2024, earlier in the year, came right down here, bounced up off of that. We're getting close to that again. If we come down here, are we going to be able to bounce up off of that? Or if we end up falling down below it, that'll be more negative. Then just areas that we're watching, keeping an eye on sentiment here. Now, we're neutral as far as the gauges that I usually look at, but every week there's a thing called the Investors Intelligence, and these are people that are supposed experts about the market, and if they're giving buy or sell signals, when they're very bullish, this really goes up, and we're getting quite a high reading here. It's a little bit lower than what we were seeing a week ago, where it was 3.98. Now it's still coming in at 3.8. Just want to keep an eye on that. But it's kind of contradicting what we're seeing with our other sentiment gauges. Then keeping an eye on jobless claims, which that's the red line, where we had been coming down, and then boom, we started to go back up. That's the red line. The continuing claims kind of been going sideways. They went back up as well. And we're also seeing the unemployment rate going back up. Is this some kind of a new trend? Is this something that the market needs to be concerned about? We're just watching that, and we get these reports every Thursday. And then we're also watching the spread between risky and not as risky bonds, still showing not a lot of fear here when this goes down. Now, at some point, you can see other times this led to some kind of problems later on, but we're not really seeing any problems at this point. It just means there's not a lot of fear going on in the bond market. The skew index been on here for over a week now, getting very high readings. Not sure if the market needs to go down or up for this skew index, which is a variation of the VIX, needs to drop down out of this red area. Because I was going with the assumption that, okay, on the down days that we saw earlier in the week, that's when we saw the skew index going down. Then we had an up day and it started to go back up. And then we had a kind of a crazy session on Friday. And it's hard to know the context of this right now. That's why I have it in the watch area. And the Fed is going to be coming out and probably cutting interest rates 0.25% or 25 basis points. That'll be on Wednesday, the 18th. And there's a 96% chance that is what's going to happen. But it's not just this. It's what do they say in their statement? What about that little scatter plot thing that they also now put out? What about the press conference? Those are all variables that the market's going to be paying attention to and then dealing with. And then we're also keeping an eye on the large cap to small cap ratio. The Russell 1000, that's large caps. The Russell 2000, those are the small caps. And we've been coming back up here. Now we've been kind of chopping sideways recently. This was the big downward move that we saw in August. But if this continues to go up, that means the large caps are outperforming the small caps. But there's a lot of people out there thinking that the small caps should kick into gear and really start to outperform. If that's what ends up happening, we're going to see this ratio going down. And this is another area, and I could put it on the positive. I could also put it on the negative side because it depends on what chart you look at. There's the first couple of charts here. This is more negative. This is the SOX index, which are semiconductors, which are a huge part of the tech sector, which is a huge part of the overall market. We're below the 50 and 200-day moving averages, and we've seen a recent death cross here. That's negative. Can't get much more negative of an interpretation than that. And when we do a ratio between the semiconductors and the tech sector, we're coming down with that ratio. Now, we did see a nice little bounce on Friday, but we need to see more. We need to see the trend actually turn and go up for this to be more positive. Those are the negative charts. On the positive side, we have the SMH Semiconductor ETF. It's still above its 200-day moving average and actually dealing closer with its 50-day moving average. And you can see where we came down here in 2023, bounced off the 200-day moving average. Earlier in 2024, bounced off there a couple of times. We've been holding above this support right now. Are we going to be able to hold above that this time? And then we do a ratio between the semiconductors and the Dow. And when this is going down, that's more negative. Well, semiconductors had a good day on Friday, and the Dow did not. That's why we're going back up a bit here with this ratio. But overall, we want to watch this to see if we're going down, that's going to be negative. If we're going up, that'll be more positive. And then we have the 10 to the 2-year yield curve, which stopped being inverted a while back. I forget the actual date, but we're above zero here. Well, another thing that happened, the 10 to the 3-month is gone back to being uninverted too. Now, different folks will have different interpretations, but when they both go back to being uninverted or going back to regular, that's usually when we start a countdown to see if we're going to go into a recession. 5, 6, 8 months or so. Now, the charts that I look at to show if we're going to go into a recession, a lot of those charts say that we will go into a recession. Other charts that we look at say we won't. And everybody's going to have an opinion. I look at the data and we'll just evaluate the market as things unfold day by day by day to see if that's actually what ends up happening. But the market is not anticipating a recession. But you get the perma bears and the doom and gloomers and the people that really think they know what's going on. And some people I actually respect are saying that we're going to go into a recession. Other people that I don't respect also say we're going to go into a recession, and vice versa with that whole thing there. And we want to keep an eye on the dollar. It's going in an uptrend now. We're seeing downtrends develop with the euro, the British pound, and the Japanese yen. You want to do some traveling? Probably get a pretty good exchange rate compared to the US dollar. And then seasonality. This is when Santa Claus rally or the January effect, whatever you want to call it, uh, we did start already right before Thanksgiving, but then we've kind of stalled out over the last week or so. But going from now until the second day of the new year, 2025, we tend to see positive seasonality both for the S&P and the small caps. And this is another one. We're coming up to the week here, December 16th through the 23rd is what I'm looking at here. The 20th will be Friday. But this is the negative seasonality that I was really harping on. We're going to work our way through that as of Monday's session. So we'll have to see if that's going to mean anything. But then we really kick into gear when we get into the later part of, or latter parts of December. And this red dash line, these are supposed to be the small caps on a seasonal basis. Then we have this crazy thing called the Hindenburg Omen. And if nothing happens, we only have until Thursday to still deal with this. The perma bears love this thing. We need to see a confirmation spike, and we have not seen one yet. And we have until Thursday, which really means Friday, because there's a 1 day lag with how this chart is updated, for us to see, is there a confirmed Hindenburg Omen? The perma bears say, oh yeah, man, they're just salivating at the teeth, thinking that, okay, we're just going to go in the toilet now. And we might, but remember, they're wrong 70, 80, 90% of the time, because the market has a tendency to go up. We like to be realists, not perma bears or perma bulls. So thank you. I hope you have a wonderful weekend and a great week. Please feel free to check out some of the other videos that I post throughout the week. I'll be updating all these charts, and I will talk to you in the next video.